Of course, the whole issue of interest rates and inflation still dominates markets and indeed the news cycle and politics as we speak. Let's go now to one of the foremost economic commentators and forecasters in this country, the Chief Economist of Westpac, Bill Evans. Bill, many thanks for your time as always. The Reserve Bank, I note from some, is being suggested to be embarrassed if it doesn't raise interest rates next week in May. Is that your sense? Would the Reserve Bank have a sense of shame or being embarrassed for not moving interest rates at that meeting?
Look, Ross, no one in the market predicted that sharp lift in the underlying inflation rate. It was interesting that most people were at 1.2%. It came in at 1.4%, but the annual number lifted was 3.7 compared to the market expectations of 3.4. Underlying inflation is a pretty slow-moving beast, so that's a big miss, and it's sending the Reserve Bank a signal that, along with the rest of us, they would have underestimated that number, so they need to act now.
And so what you're saying is that they do need to act sooner rather than later. They can't afford to wait until after the election, until June perhaps, because they do risk getting behind the curve, especially if the US Federal Reserve in May, in next week, goes up by 0.5% itself.
Yes, well, that's certain that the Fed will go up by 0.5%. And then when we get to the June meeting, the Fed will be absolutely expected to be going up by another 0.5% the week after the June meeting. So from our perspective, we've got a 15 basis point move next week and then 25 in June. Last week, we predicted 40 in June. So it's really only a reallocation of those 2 months, of those two meetings. And the reason for that is just that higher than expected number that came out for inflation.
Does it also mean that the peak of interest rates here in Australia, as the Reserve Bank tries to quell this outbreak of inflation, that it now has to be higher? The people have got to prepare themselves for higher interest rates than what otherwise might have been expected?
That's a good question. They will be starting a bit earlier than we expected. The big thing will be the interaction between containing inflationary expectations and those constraints in the economy represented by the high leverage in the household sector. So the market is expecting that rate to peak at 3.6%, which would be a variable mortgage rate of around 7%. I just don't think that the economy would be able to cope with something like that. I think the signals of falling house prices and slowing consumer spending and rising unemployment will be there before that market rate gets there. So we're still pretty comfortable with our terminal rate of 2% to be reached in May next year.
Yeah, so I was quite taken by the frankness of Jerome Powell, the chair of the US Federal Reserve last week, saying that if the central bank, the Federal Reserve, doesn't get these settings right, it could risk a recession in the United States, the world's largest economy. Is that now increasingly a real threat for Australia as well?
I don't see the recession scenario playing out in Australia because I think the inflation story will settle back down next year. So the Reserve Bank will not have to go so far to generate that inflation outlook. The US, of course, has got a much higher inflation rate, around 8.5% compared to our 5%. We think that the quarterly number for the underlying inflation rate in the March quarter is going to see the peak at 1.4%. That's a huge number, but we think it will be the peak. And as we go through the rest of this year and next year, with energy prices turning from a positive to a negative, and some of the supply chain shocks starting to ease, I'm expecting that next year inflation will be back near the top of the band, but in that 2 to 3% band, which will allow the Reserve Bank to take their foot off the brakes by the middle of the year and avoid that recessionary scenario you're talking about. But if they needed to go as far as the market expects, then you'd get very, very worried about the impact on the household sector, the housing market and the overall economy.
But what you'd be really saying to business and to consumers right now is you should pretty much expect in pretty much every month until the end of the year a 0.25% rate rise, unless you see a 0.5% rate rise and then they wait a month or so to see what the impact of that might be.
Yeah, I think that comparing us to the US and to New Zealand and to Canada, there's one very big difference is that the RBA has much more flexibility. They have 11 meetings a year. The US only has 8, Canada has 8, New Zealand has 7. So they can afford to err on the side of caution knowing that in 4 weeks' time they've got another crack at the hit. So I think that they'll miss a couple of months this year, reaching a peak of 1.5%, because at 1.5% things get a little bit uncertain as to exactly how far that will impact upon the housing market and the household sector. So after that 1.5%, I think they'll become more cautious. But we're only looking for 2 more hikes next year to peak around the middle of next year.
Okay, so just a final one for you, and that is really about Australia's economy right now, because while people are obviously concerned about rising interest rates generally come when the economy is performing well, and that's often the reason why you get this inflation. Now, sure, there are some external shocks, but in reality, the Australian economic growth performance is pretty good. So what's your assessment of the economy right now?
Oh, look, I think the economy is strong at the moment. Businesses are investing, households are spending, the economy's reopening. Our card tracker, which looks at turnover in our credit and debit card businesses, are indicating strong growth. So I think for the next couple of quarters, we will have a pretty strong economy on our hands. But as those interest rate hikes start to really take hold, the housing market turns around, households will become a lot less confident. And we'll start to see the economy slow. And that's why we've got growth next year of only around 2.7%, a fair bit down from growth this year, which we have around 5%.
Bill Evans, always good to get your analysis, and many thanks for your time today.